Today's topic is one that affects everyone, whether you're investing, saving, or just buying groceries. And this is inflation.
For the second month in a row, mortgage holders have been dealt a blow as the Reserve Bank raised the cash rate again.
You didn't vote for it, you don't see it on the bill, but it quietly erodes your wealth every single day. So today, we'll unpack what inflation actually is, why it happens, how it's measured, and why it matters more than you think. Lastly, we'll talk about how to position yourself against it.
The Reserve Bank Board lifted its official rate by 0.25, taking it to 4.1%. Today's increase, a cruel blow, and there could be more to come.
Let's get into it. Hi everyone, welcome back to another installment of the Investing for Doctors podcast. I'm your host, Dr. B. So, what is inflation? At its core, inflation is simple. Inflation is the rate at which prices increase over time. So if inflation is, say, 3% per year, something that costs $100 today will cost you $103 next year, on average. But here's the key insight. Inflation isn't just about prices going up. It is actually about your purchasing power going down. So every dollar you have today is worth less tomorrow. Your money buys less, and even if your bank account stays absolutely the same. So for instance, if you left $100,000 in cash and it just stayed in a bank account with no interest, and say inflation averages about 3%, after 10 years, its real value is closer to $74,000. So on paper, you have zero losses, but that's quite a bit of a loss in reality. Now we begin to see why inflation is such a big problem. Now you might ask, what actually causes inflation? Inflation doesn't really happen just randomly. It's driven by a number of key forces that we see in markets. I think the first thing we got to think about is what we call demand pull inflation. So what this means is that there's a bit too much money chasing too few goods. So for instance, during COVID, we had a lot of stimulus payments coming from the government. And that's just extra money that suddenly appears in the system. And what do people do with that money? They buy things. And so when you have extra money coming in and you buy more things with a fixed amount of goods to sell, people chase the price and the cost of things go up. Now, the other thing is strong consumer demand, right? So when times are feeling good, people are feeling rich, people spend more, they buy more, and so on average, prices go up. Now that's inflation that's driven by excessive demand. And as you can see, when people want more things, they have to pay higher prices for it. So this is the typical economic principles of supply and demand. Higher demand leads to higher prices. Lower demand leads to lower prices. Now, the other side of inflation that we are probably hearing a lot of in recent times is what we call cost push inflation. Now, what this means is that the cost of production or the cost of an item that we buy goes up. For instance, if your raw material of, say, manufacturing a computer goes up because your chips cost more, right? The cost of production goes up. And so what businesses do, rather than absorb the cost of that increase, they pass that cost on to the consumer. And obviously there are key drivers to this, such as one of the things that we're talking about today is going to be energy prices, right? When the cost of petrol goes up, the cost of crude oil goes up, everything gets more expensive because we need power to generate it, we need transportation to ship the goods around, and we need a sort of diesel to power the equipment and machinery that drives these production. Now, the other thing that's a major cost driver is wages. When wages go up, the cost of making something goes up as well. But on the other side, if through automation, through machinery, through AI, for instance, you can get rid of people, the cost of wages goes down, and you can actually help with the cost of production. Now, the last thing that we've seen a lot in recent years with the Ukraine war and also now in the Iran war is supply chain disruption. So when supply chains are being disrupted, cost of everything goes up because it's more costly to ship things, it takes longer to ship things, or there's an insurance premium because of war or chaos that's happening in the world. When this happens, prices go up again. So if you look back to what we had in COVID, when all the shipping containers stopped from China, or when we have these geopolitical shocks right now in the Middle East, the cost of things are bound to go up. And I'm sure we're all seeing it at the cost of diesel, the cost of petrol going up at the pumps. Now, these are sort of what we call supply and demand driven causes of inflation. But there's also other causes which we'll talk about, which is the monetary expansion. So what this means is that there is an excessive supply of money in the system. Now, how this happens is that when central banks, they control their money supply, and they can do this by increasing the supply of money, for instance. And typically you see this in what has been done in the US with printing additional money. Increasing the supply of money causes more money in the system, and so each unit of currency becomes less valuable because there's more and more of it. All right? And this is when inflation is driven by monetary policy and not just economic principles of supply and demand. Now, these things have huge issues, especially if the governance of certain countries are not run the way they should be. So we've talked about some of the features of inflation. We should now look at how inflation is measured. The measurement of inflation is actually a rather complex system of actually doing that. And in Australia, this is measured through the Australian Bureau of Statistics, and it's actually measured based on what we call this basket of goods and services. Now, what this basket represents is what we call a typical household. All right. And this typical household could be very different from you and I, or basically anybody that's viewing this. And this basket includes categories such as housing, food and beverages, transportation, health, education, insurance, and recreation. All right. And so each of these categories is assigned a weight based on how much a typical household will consume on it. So, some households might consume a lot in food and beverage because they eat out all the time, and some might do less. So this is, again, an aggregated basket of goods, and the weighting is also averaged out based on the average Australian household. So it is not representative of your individual circumstance. Okay, so how this CPI or Consumer Price Index is calculated, it's done through a few logical steps based on this basket of goods. So first things first, the ABS actually collects thousands and thousands of pricing points from across the market. And these pricing points will come from supermarket, petrol stations, even healthcare providers like ourselves, and also online retailers. And they do this across different capital city regions and rural areas. And what they do is that they can, using this, they can calculate what the average and prices of, say, similar items. Now, the exact basket in terms of what is actually utilized in this, it's I'm sure it's a very complex calculation, but it is basically aggregated and averaged across brands and different things. For example, tomato sauce, they might have home brand tomato sauce, they might have branded tomato sauce. I'm sure there's a system of calculating the average of those items. Now, if you want to find out more about it, you can go to the ABS website, and they actually have quite detailed methodology on how all of this is calculated. So now, after we have the price, what we need to do is actually weigh this basket. And the weights are actually derived from this annual survey, which is called the Household Expenditure Survey. And that's been collected annually since, I think, 2018. Whereas prior to that, it was done through a census that's done every few years. So we actually have a much better weighing of the basket today compared to, say, 10 years ago. Now, I'll just give you a broad example on what this weightage looks like from the 2025 data, which we are using in 2026, is that housing roughly accounts for 21.4% of this basket. Food and non-alcoholic beverage is at 17.4%. Recreation and culture is 12.7%, and transportation is about 11.5%. So these are the four biggest items on the basket, and altogether they make up about 63% of this basket. Now, you might ask, as a astute observer, it's like, I feel I actually pay a lot more for my housing and accommodation rather than just 21% of my household expenditure. And the reason for that is that housing is not actually made up of the cost of your asset. So your mortgage and interest payment is not factored into this weightage of goods, of your housing, right? So the housing basket is actually made of two components. One is the actual cost of rent. So rent affects the housing prices. And the second thing is the cost of new builds. So the cost of building a new property is included. It does not include the land component, and it does not include, the cost of assets, which is why it feels so skewed, because a lot of doctors, if they're quite highly leveraged into the owner-occupied, they're probably paying a much larger share in from a housing perspective. Now, after we get this weight and we have the price, we can actually use that to construct this index, which is you multiply the weighting by the prices of these baskets, and then you aggregate together. All right. So the CPI, or Consumer Price Index, is actually an index, and it's not a dollar value, and it's based off a base year. So for instance, if we took last year as 100, and this year we found that the prices have gone up to 103, which is that equates to 3% inflation. That's quite straightforward. So every year on year, the index might go up. So for instance, if it went up from 103 to 106, that's not actually a 3% increase. That's actually 3 divided by 103 times 100%, which is a little bit less than 3%. So that's how it's mathematically calculated. Now, in terms of the reporting of CPI, in Australia, we've historically reported it every quarter. So the quarterly CPI is what we call the official headline measure, or the headline inflation rate. And that has always been reported quarterly. But recently, the ABS is introducing the monthly CPI indicator, and which is just to give, I guess, consumers and those in the finance industry a more rolling idea of what inflation is doing, so we have more up-to-date figures. Now, is this good? Is this bad? We've yet to see how that affects policy decisions. But in general, more information is always good in my view. What we do with that data is really up to the policymakers. Now, we've talked about this headline inflation, which is sort of the real inflation rate, but we actually distinguish headline inflation from what we call the underlying inflation, which is the core measure that we use for policy. And the reason for that is that headline CPI can be quite volatile, especially when we talk about fuel cost, we talk about fresh food, and it includes all pricing changes. And it does fluctuate quite differently from month to month, quarter to quarter. So what we actually need to do to make policy decision is that we use this idea we call underlying inflation. Now, the Reserve Bank of Australia, which is sort of the central bank, actually focuses on two measures. The first one is called the trimmed mean inflation. And what it does is it removes the extreme of prices on both the highest and the lower end. So it gets you a more averaged out data. And it also does another measure, which we call the weighted mean inflation. And it sort of takes the middle of the price movements. And, these are more stable figures that we utilize, and it's considered more reliable for policy decisions because it gets rid of the seasonal or some pricing shocks due to what is happening around the world today. One of the things when we talk about inflation is that as I mentioned earlier, housing is treated differently in the calculation of CPI. Now, as I mentioned earlier, CPI includes new dwelling construction costs. All right, it does not include the full cost of houses or prices, which we call the asset prices. So, if you're seeing someone selling a $2.5 million property and then it becomes $3 million, that actually has zero effect on CPI, right? And what this means is that property price booms or crashes do not fully show up in CPI, and it does not factor in the cost of paying your mortgage or the interest that you're paying on your mortgage. Okay, so when interest rates goes up, a lot of homeowners feeling the crunch. Those crunch is not factored in your CPI. So you might feel like you're paying a lot more, but in reality, the CPI is probably less than what you are feeling personally. Okay, so for nearly most homeowners, CPI does not feel real because it does not really affect the mortgage payments, and your interest payments is not really affected by CPI. It does not affect CPI, and well, rather interest rate affects how much you're paying in terms of your monthly repayments. Okay, so that's the first thing why CPI does not feel real. Okay, this is obviously very different from people who rent because CPI includes the rental cost of dwelling. Now, the next thing that we do see in the measure of CPI is what we call a substitution effect. For instance, if beer suddenly became really expensive for whatever reason, we can always switch to wine. Okay, so which is maybe less expensive. So it sort of moderates the rate of inflation. If one thing goes up and the other thing doesn't really change, if people may move to a different purchases or change their spending habits based on the pricing. All right. So in this situation, it might either overstate or understate what your personal lived inflation is for some household, depending on your lifestyle choices. Okay. And lastly, your personal inflation is not equals to the CPI. I think I've said this multiple times. What you feel and what the CPI rate is, it's going to be wildly different depending on a number of factors. I mean, namely lifestyle, your income level, where you live, what's the composition of your family, do you have a mortgage or not, and that sort of thing. So, for instance, doctors who have high mortgage, they're very heavily exposed to housing and interest rates. The CPI might not feel real to you, and you might actually be paying a lot more because when CPI goes up, interest rate tends to go up. Now, for retirees who already own their homes, they're not going to feel that pain as much. But if healthcare costs go up, insurance costs go up, they're going to feel more of that. Okay, so your personal inflation is very personalized depending on who you are, where you are, what you do with your life. Now, CPI is what we actually call a consumption index. All right, a consumption index is based on your spending and habits, and it's not an index for wealth. All right, it does not fully capture the growth of asset prices, so asset price inflation in terms of properties on shares and that sort of thing. And the wealth inequality of inflation is not felt as much. All right, so because those who have lots of assets do not feel inflation as much. And lastly, if you have a very specific lifestyle habits, yeah, you're going to feel that the effects of inflation again. Okay, so the bottom line is that in Australia, we measure inflation using the Consumer Price Index, which is calculated by the Australian Bureau of Statistics, and it's based on this basket of household spending. Whereas the RBA, the Reserve Bank of Australia, our central bank, they focus on the underlying inflation, which is more of a trimmed or weighted median CPI. Okay, so CPI is useful, but it's an imperfect measure, especially in Australia, where a lot of people are quite asset rich and asset heavy. All right, I think we've talked about why we have inflation, what inflation is and how it's calculated. Now, the question is, why does inflation matter? Okay, because we talked about all these things. You see this stuff in the news every day. Why does inflation matter to the average person or to anybody for that fact? All right, because I think the first thing first, it's inflation reduces the real value of your savings. All right, so if you have cash, your cash is always bleeding in value unless your cash is earning something for you. Okay, and one of the things that it does is that inflation actually transfers wealth from people who save to people who borrow. I'll explain that a bit more later. And it also benefits people who hold assets, and it penalizes people who hold cash. Why do I say that? Because the prices of asset tends to grow faster than inflation. I think on average across properties, across shares and equity, the growth in those assets will usually outpace the inflation rate. Because most of us know that if we're investing in a broad-based ETF, it grows something like 8% per annum, whereas if the inflation rate is often sitting about the 3% in recent years. So you're actually getting a 5% real growth in your assets. Now, why do I say that it's a transfer of wealth from savers to borrowers? So if you're saving money, you're losing absolute value on your money. All right. You might get the interest rate back, but that is often just above or at interest rate. Now, for people who borrow money and use that money to invest in assets, say if I borrowed money at 5% and I invested it in an 8% asset, so I'm already making 3% growth on that. All right. So, and for me, the value of the money that I borrowed is getting cheaper and cheaper and cheaper every year. So if there's a 3% inflation, I borrow at 5%. The cost of capital, the real cost of capital is only 2%, and I am making additional 3% on that. So get this, the winners at the end of the day from the inflation game are actually people who borrow money, because when they repay the loans, the dollar value doesn't really change that much on your principal. Yes, you pay interest on it, but the principal value is constantly being diminished through inflation. And so technically the loans are actually becoming cheaper and cheaper in real value dollars. Now that's the first thing. The other winner is government, right? Government always borrow money and they issue debt, and that debt gets eroded over time. Again, there's interest that they have to pay on it, but the absolute principal drops in value over time. So higher inflation is actually good for government if the interest rate remain constant. But obviously, we'll talk about this later. These things do change, and there is a bit of a dynamic around that. Now, lastly, the winners, as I mentioned earlier, are asset owners, whether it's property, equities. Those assets grow faster than inflation typically. So who are the losers? The losers are cash savers, people who save money in the bank account, who have the money in the transaction account. You're always losing money on that. Okay, so that's the first thing. The second thing is retirees who are on fixed income. So they're getting X amount of percent return on their income. If inflation goes up, their returns get eroded. Now, lastly, wage earners also suffer because, if we're seeing that wage often lags inflation. When inflation was 5% and up during the post-COVID period, wages were not growing as fast. So, what we talk about, real wages have actually been going down in Australia. And so $1 you earn today is going to feel a lot less than $1 you earned 3, 4, 5 years ago, for instance. All right. And without the consequential growth in the absolute amount of money you earn, your earning power and your purchase power is getting eroded through inflation. So the critical point to take home is that if your income or your investments are not outpacing inflation, you're getting poorer. Even though normally, the absolute amount is stable, you are getting poorer by the minute if your investments are not beating inflation. All right. So now we talk about inflation and certain investment assets. All right. So as I mentioned, different asset classes, they will respond differently to inflation. And broadly speaking, equities, properties, they're often inflation protected, and they will grow with time, and they often outpace inflation. All right. The main difference is that in equities, we typically are not borrowing money against equities, so we own the equities outright. If inflation comes, the business often raise prices and they pass on that cost to the consumer, and so it can actually act as a hedge against inflations. In time of high inflation, you find that equity prices go up, quite a bit as well. Now, the next item which a lot of us are exposed to is property. And again, property does tend to outpace inflation, but it has an added mechanism in it, in that it is what we call inflation protected. So when we have rent, that will grow up, increase with inflation. So if it's an investment property that we're renting out, if inflation goes up, rents go up. So if you remember during the COVID era, rents suddenly went down because there was not enough demand. Afterwards, when we reopened Australia to tourists and students, there was a massive increase in rent. And that's purely because of the supply and demand dynamics. So rents do go up, and often it goes up with inflation. Now, the other thing is that its properties are sort of a dual purpose. You get the rental and you also get the asset appreciation. Now, the asset appreciation often does beat inflation, albeit sometimes could be just a little bit above inflation. However, the drawback with property is that when inflation goes up, what usually goes up is interest rate. So if you are leveraged and you have a mortgage, the cost of holding will go up for you as well. And so these things tend to be a bit more sensitive to interest rate hikes and changes. Now, the other asset class that is often talked about is sort of bonds or fixed income investments, and they typically are negatively affected by inflation. When you have inflation, it erodes the absolute gains you get from bonds. And typically bonds will beat inflation by a little bit, but not too much. If there are low risk bonds, the higher risk bonds there will always be a bit more margin. Now, where bonds do well is that when you have inflation and you have an interest rate rise, the prices of bonds will go up, and sometimes the newer bonds needs to give you a higher coupon rate or interest rate to correlate with that increase in interest. But by and large, bonds, they don't grow as much when inflation is high. So the last item on this list is cash. Now, if you're holding cash in a low interest bank account, you're guaranteed to lose value and purchasing power over time. That's just because inflation will erode your purchasing power over time. However, if you put it in a high interest saving account, often it will offset the inflation, but by a tiny little bit. So cash is probably the place where you don't really want to put too much of your assets in. And the key takeaway here is that inflation forces you to invest and take risk, because if you don't take risk, you don't invest, you're almost guaranteed a loss due to inflation. All right. We talked a bit more about inflation. And, I've mentioned a lot of things about interest rate. Now, inflation and interest rate often go hand in hand. And the interaction between inflation and interest rate is actually a core feedback loop we see in the modern monetary policy in Australia. So in Australia, this loop is managed by the RBA, or the Reserve Bank of Australia. So as I alluded to earlier, what this means is that when you have high inflation, you typically have higher interest rate. And when you increase interest rate, it reduces inflation. And, the two of these numbers will eventually get to a balance. All right. Obviously, the changes are not instantaneous, and it operates through a transmission mechanism that goes across the economy when we make an interest rate change. So every month or two, the RBA meets in their meeting, and then they would decide to either keep interest rate on hold, increase or decrease interest rates. And that's often done, and people will try and predict whether there's an interest rate rise or not based on various figures that's coming out of the market. Obviously, the RBA does not only use inflation as its measure. It also uses employment and other factors to make the decision about changing the interest rate. But by and large, the goal of the RBA is try to maintain inflation between a 2 to 3% band. And when it exceeds that, typically the RBA wants to tighten monetary policy by increasing interest rate. So how does higher interest rate actually lead to a decrease in inflation, you might ask? And it's actually doing it mostly from a demand side mechanism. So higher interest rate is supposed to reduce demand for goods. And when you have less demand, the prices of goods typically goes down or slows the price growth. So how does it work? Now, it works through multiple channels, and the first channel that we are all very familiar with is through borrowing and lending channels. When you increase the interest rate, your mortgage repayment increases, business loans become more expensive, and new borrowing decline, and people need to spend more money paying their interest. And so if they're paying more on their interest, they're spending less money elsewhere on investments and on consumption. So that's the first thing. Now, we talk about consumption. So as I said earlier, if households are increasing their debt servicing, their discretionary spending falls. And, this is quite impactful in Australia because in Australia, we have a very high percentage of households using variable rate mortgages. Compared to some countries, say like the US, where there are lots of, it's a high percentage of fixed rate mortgages, which are less affected by interest rate. In Australia, we are very easily affected by interest rate because the majority of people are on variable home loans. And so the moment they increase interest rate, usually within the month, the banks will often pass on the savings or the increases to the consumer, and they will feel that pinch and the discretionary spending. And so this has a very fast transmission in Australia because of this. The other reason for it is in Australia, we actually have a relatively higher rate of leverage in our households for our housing. A lot of doctors will borrow 90%. A lot of people are borrowing 80%. And if you're a first home owner, you can borrow up to 95%. So when you have high leverage, interest rate grows up, you actually have to spend quite a bit more on your mortgage, and that immediately has repercussions on the individual spending and household expenditure. So the last thing that is affected is through the asset prices. When inflation goes up, interest rate goes up, the property prices often soften, and sometimes the valuation of equity changes. Now, this doesn't actually have much to do with people's cash flow, but if the asset prices are not going up as much, people actually feel less wealthy. And when you feel less wealthy, you want to spend less and you want to save more. So this is actually quite an indirect mechanism. All right. So now the last channel is through foreign exchange rate. So, without going too much into how foreign exchange works, when we have a higher interest rate, the Australian dollars tends to become stronger compared to other currencies because we're paying more for people to hold our dollars. And a higher interest rate equals to higher currency value typically. Now, if our if our Australian dollar appreciates against, say, the US dollar or the Chinese yen, imports become cheaper. And so inflation secondary to imported items will feel cheaper as well. And so that has another dampening effect on inflation. However, this effect also goes the other way. If our Australian dollar becomes weaker, our imports are going to feel more expensive, and that also drives inflation. So Australia, as a country that doesn't really have much of a manufacturing base, is going to feel a lot of imported inflation or deflation, depending on the basket of goods we're choosing to buy. So a lot of consumer goods, they're being manufactured overseas. That would affect us based on currency changes and volatility. All right. So when we have all of these factors playing in the system, there typically is a little bit of a lag effect. When we move interest rate, inflation doesn't respond immediately. So typically monetary policy, which is the way that our central bank controls inflation, it operates with between a 6 to 18 month lag period. So the rates hike today is going to affect inflation next year, or at the earliest 6 months down the track. And obviously you can see that this creates a major problem, because you can turn the tap on and off, but you don't see the effect for many months later. So if you over tighten, you could actually lead to a recession. Or if you don't tighten enough, you get persistent inflation. And so this is the maths that the RBA has to balance on a month to month or a quarter to quarter basis. So now when obviously the reverse is true, if inflation is too low or the economy is too weak, then the central bank can cut interest rates, and that will spur more borrowing, that will spur more investment and spending, and so that will stimulate demand, and then it pushes inflation back up. Okay, now these are sort of general principles about monetary policy. However, there are quite specific dynamics, which I've alluded to earlier, which are specific to Australia. Okay, now Australia is quite sensitive to interest rate changes because of a number of factors. The firstly is that, as I mentioned earlier, we have a high percentage of variable rate mortgages. And so this has a rapid transmission to household, because almost within the month, households will feel their mortgages go up. They would have inflation feels real to them. Okay, and this has immediate cash flow effects, and that will affect demand very quickly. Now, this tends to affect the younger population who tends to hold mortgages, whereas people who are the older generation or the retirees who already paid off their property, it won't really affect them that much. So it has a duality effect to demand and to the demand in the market. People who don't have mortgages are not really affected that much. People who have mortgages will be affected disproportionately, and that tends to be young people. Now, the second thing is that in Australia, we have quite a high household debt. And again, that amplifies the rate. So if you're young, you hold a lot of household debt through your mortgage or to investment properties, that amplifies the effect again. So again, it's disproportionately affecting younger people and sort of families, growing families with young children as well. Now, the third thing, again, it's all related to housing. Australia is very, very heavy on housing, right? Property is the major determination of wealth, and it is the biggest driver of wealth in Australia, which is, it's not really an overly productive asset, but it is what we have. So again, interest rate affects housing disproportionately, and so people are going to feel poorer or richer depending on the movement of housing prices. So the summary of that is, because we're so housing dominant in Australia, interest rate hikes or interest rate falls will hit the Australian economy a lot faster than other economies, for example, the US economy, where household debt is not really tied to property as much because they have a much higher rate of fixed interest mortgages. Okay, so the irony of all these things is that, remember how we talked about demand pull and cost push inflation? Interest rate is really a tool that affects demand predominantly, and less so on supply side. Okay, so the control of interest rate, it's a demand management tool. As I mentioned earlier, it causes people to feel richer or poorer and spend more or spend less. And why does that? I've already explained it. It affects your consumption, it affects your investment, and it affects sort of how easy you get credit and the cost of credit, as we discussed earlier. However, even though it is mostly a demand side lever, it can also affect supply side indirectly. Now, this is a lot slower, and it is often less predictable than the demand side effects. Now, how this can affect supply side, I'll go into a bit of that. And as we go through some of this, you can see that at times this could be counterproductive. All right. So the first thing that affects supply side is it affects supply through the investment decisions that firms and companies do. Higher interest rate means increased cost of capital, and it reduces business investment. When you reduce business investment, what does it do? It reduces maybe the production capacity of businesses. So over the longer term, it might actually reduce the supply capacity because of the failure to invest in production. Okay, and where we often see this is when there's higher interest rate. Property developers do not want to build because the cost of construction loans are higher, and so it actually delays housing construction. And with less housing construction, there is lower supply of new houses. And what happens? Demand outstrips supply, and you have supply which is not in keeping in growth with demand, and so prices rise. So paradoxically, by increasing interest, we are actually decreasing supply of housing and production, for instance, and that actually compounds inflation. All right. So as I said, this housing supply example is a persistent problem in the Australian economy right now, and it's a key paradox. When we increase interest, it actually reduces housing supply, and it leads to further rental inflation. All right. Now, the other thing it can do is that it can actually lead to more cost push effects. As I mentioned, business increased financing costs, increased costs of doing whatever they need to do, and these increased costs could be passed on as higher prices, and which leads to a slightly inflationary pressure from the supply side. So again, it could lead to a mild cost push inflation, as well as we're trying to reduce demand. We're actually still causing a supply side cost increase. All right. So why does this matter? Again, it is a lot more complex than just increasing inflation, decreasing demand, and reducing inflation, because over time, other things move along as well. Supply side inflation might take a longer time and to come into play. Now, the other thing is that when we have inflation that is driven by supply side factors, such as the oil price increase we've seen recently with the Iranian crisis, that is not going to be solved by demand side policies. So you can increase inflation, you're not going to cause the cost of petrol, the cost of diesel to go down, right? Because it is predominantly supply driven. And the other example I've used is the housing shortages. You're not going to reduce the reduction in demand is not going to keep up the pace with the shortfalls in supply, and increasing inflation actually exacerbates the housing supply problem, and it can worsen the problem in effect. All right. So now we have probably a better understanding of inflation, interest rate, and how they interact, and how it's actually a lot more complicated than we think, than what, say, the newspaper would actually say. Now, the final take-home message is that central banks like the RBA, they don't fix inflation by increasing supply. They fix it by reducing demand to match the supply constraints. And if your supply constraints far outstrip your ability to reduce demand, you're not going to solve inflation. So what we're seeing right now in the Iranian crisis, with the Straits of Hormuz closed and Australia getting a lot of its petroleum through the Middle East, we are going to have a major supply side problem. Just to give you some figures, it takes roughly about a month for petroleum to actually go to the refineries in Asia, and then for the refined products that land on shores. So we are about week 3 into the Iranian crisis at the time of this recording. That has not hit Australia. That effect has not hit Australia yet. All right. And in Australia, we have about 30 to 35 days of strategic reserves that is predominantly held by private enterprises, which is the refiners and the suppliers. Now, if the Iranian crisis extends beyond 4 weeks or a month, we will need to tap into that supply. And I can guarantee you the price of petrol, the price of diesel is going to go even further up because we are getting into the territory of releasing strategic reserves, which we only have just over 30 days of. And again, what that means that it will take another 30 days for supply side constraints to be fixed if they open the Straits of Hormuz. If you think about it, we have 35 days of strategic supply, and we are already, on the week 3 of the supply constraints. We only really have a week and a half to 2 weeks before we know that we're going to be in a lot of pain. So I think more price shocks are going to come for petrol, diesel, and airplane fuel. But let's hope that the Iranian problem can be resolved sooner rather than later. Now, before we go, how do you position yourself knowing these things? Firstly, avoid holding excessive cash. You want to have some liquidity, but don't hoard too much cash than you need in the long term because you're losing wealth on those cash assets. Now, own real assets, whether that's property, equity, or businesses. Own these assets because they will grow and they will usually outpace inflation. Now, you want to focus on income growth. You want to earn more money, and you want to be earning more money than you're losing through inflation. All right? Because that means you're increasing your earning power. And there's various ways of doing that. Especially if you're a sole trader or you're a private practice or own your own business. There are ways to increase your income above inflation. All right. And lastly, I want everyone to think about in what we call real terms. All right. Which is whatever figure minus inflation. Okay. So don't ask yourself, am I making money? Are the numbers in my bank account going up? You want to be asking, am I beating inflation? Is my earning beating inflation? Are my investments beating inflation? And if you're not, then you really need to reconsider your investment strategy. All right? So before we go, one final word. Inflation, right? It doesn't crash markets overnight. It slowly chips away at your wealth. It is not a crisis. It is a constant force that we want to overcome. And if you don't account for it, you will slowly lose ground over years and decades. All right. So if you found this useful, you can share this with someone who still thinks cash in the bank is safe. I'll see you in a future episode. Thank you for listening. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.